Defining the meaning of trading. The simplest meaning of trade or commerce is simply any buying and selling transaction. Any buying and selling transaction consists of three basic parts. The first part is the trader, which includes the seller and the buyer. The second part is the asset, which are the goods, which is the item that the trader buys or sells. The third part is the price, which is the amount agreed upon by the seller and the buyer for trading the goods. First, we'll talk about the asset. In the past, the asset offered for sale or purchase were limited to their availability in the local market. But today, after the invention of the internet, the whole world is opened up and the assets are available online, creating new markets that didn't exist before. In the world of trading, there are four main things, or more accurately, financial instruments that you trade online. In this episode, we'll explain these four things in general terms and discuss them in detail in future episodes. Subscribe to the channel to receive future videos and activate the bell icon. First, there are stocks, which are simply a part of a company. To clarify further, there are different types of companies, and the difference between them lies in the method of ownership. There are private companies owned by one or two people, or a limited number of individuals. Then there are public partnerships. These are companies divided into a certain number of shares, and these shares are offered for sale and purchase in the public market, which is the stock exchange. This means that when you buy a share, you buy a part of a company. Most large companies are public companies, such as Apple, Google, Amazon, and many others. Second, there are currencies. And currencies are divided into two types. The first type is Forex, which includes all foreign currencies offered in the global market, such as the dollar, euro, and Japanese yen. The second type is cryptocurrencies, such as Bitcoin, Ethereum, and many others. These are considered the newest currencies, and you've probably heard of them. The third type is commodities, which also come in many forms, the most famous being gold and silver. The fourth and final type are derivatives, or futures contracts, such as options. These are based on the principle of buying at a price at a future time, or fixing the price of something for a future period. To simplify things, all you need to know right now is that they exist. Each of the four types we've discussed has a different market, yet they indirectly affect each other. For example, if the dollar exchange rate changes, this will affect the price of products, commodities, a company, its profits, and its stock price. The point here, to avoid overcomplicating things, is that global markets are indirectly linked. What's required of you as a trader is to excel in one market, or at most two. In sports, you can't master football, basketball, and tennis all at the same time. You need to focus on just one to excel in it. That's why in the upcoming episodes, we'll discuss each of the four markets we mentioned in detail and how to choose the market that suits you best. In the second part of the video, we'll talk about traders, which as we mentioned includes both buyers and sellers. There are different types of traders, and what distinguishes them is the time frame in which they hold the asset they intend to buy before selling it. I'll give you three examples to illustrate. The first is the day trader, who buys and sells on the same day, targeting price movements that occur within minutes or hours. The second type is the swing trader, who buys and sells after a few days, usually less than a week, targeting price movements over several days. The third type is the long-term investor, who buys and holds an asset for years, hoping its value will increase in the future. It's also advisable to focus on one type initially, but with experience and increased capital, you can combine all three. To give you background for future videos, we'll focus on short-term trading because it has the potential for significant profits. For example, a long-term investor might target around 10% annual profit, while a day trader might aim for 5 to 20% per trade of their initial investment. The major difference between them is that long-term investors don't take as much risk or exert as much effort as day traders. The third and final part we'll discuss is price. To understand how price is determined, we need to understand the theory of supply and demand. To illustrate, let me give you an example. You go to the market and find a vendor selling French apples for $10. You buy the apples and go home. The next day, you return and find two vendors selling for $10 and one for $8. Notice that while demand has not changed, when supply increases, the price drops. In this scenario, as the number of vendors increases, the price decreases until it reaches a point where it can't be lowered any further. At this point, the product is cheap, attracting buyers who start purchasing. Demand increases and the apples begin to disappear from the market quickly. Apple vendors then raise the price. Here, we observe that the supply of apples has not decreased, but the price has increased. We understand that price changes as the difference between supply and demand changes. The world of trading operates on the same principle, but price doesn't change from one day to the next. It changes every second because supply and demand changes every second. In the next episode, we'll discuss how trading works and explain it further, the role of the broker, and how to choose the broker that suits you best. If you want to continue learning how to make money, subscribe to our channel, The Idea,